We are transitioning to a new financial system? The old system must die, for the new one to be born. Unbacked crypto assets are non-replicable strings of computer code that can be owned and transferred without intermediaries, and have no underlying assets. Unbacked crypto assets establish no claim on future income streams or collateral, meaning they have no intrinsic value. Price volatility makes unbacked crypto assets unsuitable to be widely used as money, for example as a means of exchange or a store of value. Unbacked, no asset backing, BTC/ETH, no intrinsic value as they have no claims on future income streams or collateral. This means that they are unsuitable to be widely used as money, for example as a means of exchange or a store of value. If appropriately designed, stablecoins could offer lower cost, real-time payment services, while also maintaining a reliable store of value. Stablecoins currently exist in two forms. Custodial, which are backed cash and securities e.g. Tether and USDC. And non-custodial, which are backed by crypto assets e.g. UST. Systemic stablecoins. Like existing forms of money, new forms of digital money that are systemic could be publicly or privately provided. CBDC. A central bank digital currency, or CBDC, would be an electronic form of central bank money provided for retail use. A CBDC could play an important role in sustaining, and potentially expanding, retail access to central bank money. It would be a direct liability of the central banks, rather than of private banks or coin issuers. Mid-break takeaway. Stablecoins will be backed with HQLA, cash and stocks, that will then be anchored to CBDCs. Rule: unless a stablecoin is operating as a bank, the backing assets for stablecoins should cover the outstanding coin issuance at all times. Stablecoin issuance. Providers of new forms of digital money would issue and use their own money, or a coin. They could also operate more independently of existing payment platforms and networks. They could offer functionality that means they have the potential to become widely used and accepted. They could be issued by companies, with the capacity to scale up and grow rapidly. Stablecoins. New forms of digital money could be preferred by the public to commercial bank deposits, but a large-scale displacement of commercial bank money by new forms of digital money could mean a higher fraction of money in the economy backed by high-quality liquid assets rather than by loans to the real economy. This reduces the risks of runs on banks that comes from tiering. Adoption route. Existing proposals for systemic stablecoins suggest that many would be focused solely on being a means of payment. Hence, they are unlikely to pay interest to coin holders. A large-scale displacement of commercial bank money could have a direct impact on the way in which money and credit is created. This is because, currently, commercial banks retain a significant proportion of the money they create as balances in customers' deposit accounts. Real economy loans could be financed instead by more stable, and expensive, sources of funding, reducing the efficiency with which commercial banks extend credit. Increased holdings of HQLA would be met by purchases from the wider financial system. As a result, there could be a greater reliance on non-banks for credit provision. Banks' interest rates will increase. Loans move from banks to non-banks. Non-bank providers of digital money are likely to be more focused on the payments than on attracting deposits primarily held as a store of value. In response to deposits migrating to new forms of digital money, banks are assumed to compete for deposits. And they do this by offering higher interest rates. Banks are assumed to restore their liquidity positions, and hence their ability to continue lending, by issuing long-term wholesale debt. But non-bank finance is unlikely to be a perfect substitute for bank finance, especially for lending to some smaller companies. That is because this lending often requires the lender to have specialist information. CoF banks on the private ledger approving transactions on the public ledger CoF. Interoperability/TripleNet. Interoperability refers to the ability of users to switch, without barriers or undue friction, between different forms of sterling money and different payment services. The bank recognizes the importance of interoperability between services, but is otherwise technology neutral, subject to meeting its objectives. CoF. The risks of DeFi disrupting the broader financial system in the immediate future are low. CBDCs issued banks. Stablecoins issued by private entities and banks. Loans and credit for the general populace moves away from banks and goes to non-banks. Banks will oversee finance to private entities and will have higher interest rates. This keeps confidence in the CBDC and urges consumer confidence towards stablecoins, that will have much lower interest rates. Stablecoins will be backed with high-quality liquid assets, HQLAs, cash and stocks, and anchored to CBDC's banks will offer higher interest rates to compete for deposits. Businesses can issue their own digital money, as they are focused mainly on a means of payment. As stablecoins are anchored to CBDCs and require access to private information, Ripple's private and public ledgers prove the use of XRP. See the RippleNet video for more info. Interoperability and protection of data is key. Private ledger, banks, authorize payments on the public ledger. The issuance of stablecoins is highly competitive outside of banks. Hence, XRP being greater than XLM. Digital money provides cheaper, faster payments with great advantages that branch off to increase financial inclusion. A new financial system will be rolled out this year, transitioning through until 2025, when adoption will be completed. This is just the beginning. Snoot out!